This is Trepp Wire Week in Review for week ending December 25th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, Congress passed a $900 billion relief bill just as COVID hospitalizations reach record highs, and now worries over a new strain of the virus in the UK shuts down Europe. Economic data released this week mostly highlighted a mixed mood. Consumer confidence was down in December. Central Atlantic manufacturing showed some sign of improvement, and existing home sales declined last month after a 5-month surge. Joe, the relief measure, which was tacked onto an overall spending bill, had some targeted aid for commercial real estate. What did that look like?
Wow, what an honor it is for you to come to me first. I think this is a first on the podcast. It took 53 episodes, but I finally, for at least a moment, supplanted Manus in the rotation. So you'll hear in our review, our year in review episode, some repeats here, but the very first or very second episode we ever did back in early April, we actually went through a review of the $2 trillion stimulus that was passed back then. And here we are again. So how the world turns, time is a flat circle. A couple of the CRE related items in here. One was something we talked about last week, was the troubled debt restructuring relief that was granted to banks in the last time around has been extended. I believe that's extended to January of 2022. So essentially extended at 1 full year. There's a $25 billion in rental assistance that will be doled out to all the different states. The CDC's eviction moratorium, which again, is still funny that the CDC has anything to do with it, but that is extended by 1 month to the end of January 2021. And then my favorite issue, CECL. That's they've basically extended the capital relief treatment of CECL for financial institutions. So there's a bunch of other stuff in there. I think there's a bunch of money being put towards the PPP program, which is great. I think that was a very useful tool the last time around. There's another, 166 billion going directly into people's pockets. So last time around it was a $1,200 check. This time it'll be a $600 check. And the unemployment benefits, so the federal unemployment benefits will be, last time around it was an extra $600 a week, which I thought was amazing. I mean, I was about to go on unemployment myself. This time around it will be an extra $300 a week. So the enhanced, and then there's a bunch of other stuff in there, childcare, transportation, some money for the airlines as usual, some money for schools, some money for the states to help with the distribution of the vaccine. But, I don't think the market has really responded, very positively or negatively really to this news. So maybe it was all baked in, which is a little bit sad and worrisome, that the market may be coming to expect things like this in the future at any sign of economic downturn.
Well, what we did get today was word from, I believe, the Speaker of the House and President-elect Biden that this was just the beginning. I know Senate Minority Leader Schumer also said the same thing. This is just the tip of the iceberg and more spending will be coming. Whether or not that happens or not will depend upon the outcome of the Georgia election in a couple of weeks, and whether or not, if Georgia doesn't go Democratic, then whether or not the Senate will go along with an additional package. So still a lot to be determined, but the bottom line for me is that, this package, to the extent that it puts money in the hands of people, doesn't do a lot for the economy per se. It does an enormous amount for people that are unemployed, people that are worried about not being able to pay their rent or get food and so forth. And to that extent, it's very important. But for all the people that have maintained their job throughout this whole pandemic, have stayed employed, have been working from home and so forth, getting that extra $600 will be nice, but it does absolutely nothing for demand, right? It's not going to make people go on vacation. It's not going to make people go to restaurants. And to that extent, for those that have been the hardest hit, restaurant owners, small business owners, and so forth, I think it's a big swing and a miss for the most part. I think there's got to be enormous disappointment probably for people that there wasn't more creativity coming out of Washington for ways to stimulate demand for places that have been really, really walloped during the last 9 months.
Well, I think I agree in some ways and I disagree in other ways. I think that last time around, all of this money went to, all of the money that was used for consuming things went to the businesses that have been the winners in COVID, right? The RVs, the dinghies, the jet skis, the water, what are they called? Jet skis or jet skis. All those things, like not restaurants, not movie theaters, not malls, but I think there was an increase in consumption and demand. It just wasn't for the stuff that's getting killed right now. Right. And that's probably going to continue, I would think. I mean, everyone's already got their dinghies. So maybe now everyone's buying, I don't know, really fancy sleds or something. I don't know.
I tried to do my part today. I went to a Barnes and Noble in person rather than order by click. I'm not an
Should
order
have gone to a local
guy.
bookseller, Manus. Come on.
I'm not
maybe a Womrath's.
I'm not an e-buyer of really anything. I don't DoorDash. I don't Peapod. I don't get clothes that way. The only thing I get delivered.
You don't even Google.
He's just invented a couple of verbs. I just want to point this out.
You don't Uber.
Well, you guys know that, I'm still holding on to those, foldable maps that I used to get at the Gulf station back in the day. And I'll unravel them on the hood of my car when I have to go from, Boston to somewhere in New Hampshire.
You're a real Rand McNally.
So, my wife asked me today, don't you just want to order these things online? And I said, no, I just want to go in and browse and look around and spend some money and do my part. I was pleased to see that I wasn't the only one, that it seemed like, maybe 75% of what you would normally see the week of Christmas, Barnes and Noble. And I thought that was really encouraging. Everybody had their masks on. People were mostly respectful. Probably I wasn't as respectful as I could be, kind of reaching over people's shoulders for that book that I was trying to get rather than waiting my turn.
For the Tickle Me Elmo. There is something like intrinsically satisfying about walking around a bookstore. It's like the same like false sense of like getting something done as if you're like researching gym memberships, right? Like if I walk around a Barnes and Noble for 15 minutes, whether I buy something or not, I feel like, wow, like I just got smarter, right? Or like there's so much knowledge in here that I should be cramming into my brain. But if I get a scone and a coffee and I open up a magazine for 10 minutes, I've become somehow smarter by being in there.
You just carry around The Economist, on your hip pocket while you're walking around, just so that people look at you and say, God, that guy's smart.
We should do like a little podcast book club. My most recent download that I'm just started, The Brothers Karamazov. So that's a classic. I'll let you know how that goes.
You may have a few nights where you go to sleep early, having read that book before.
So we have a preliminary run of the delinquency numbers. Manus, where are we at this point?
Oh, you had me like looking through my list of books. Let me pull up my delinquency number tab. I was too busy looking at what I had read recently. To my surprise, and to go in the opposite direction of what I was saying I thought we would see on our podcast about a couple of weeks ago, I thought we would see a spike in delinquencies in December, thinking that the impact on hotels and retail would start to show itself again in the numbers, and we would see a general uptick. Even though the numbers aren't final, it looks like December is going to see another healthy downtick. At the moment, it looks like we could fall below 8% overall. We did go as high as 10.3%. People will remember back in June, this will be the 6th straight month of decline. assuming that the final numbers confirm what we're seeing now. But we do look at about a 25 basis point dip. That brings us under 8%. A modest dip in retail, so that didn't increase at all, went down slightly. Lodging did go up by about 60 basis points. Our preliminary numbers continue to show. So that got a little bit worse, kind of consistent with what I thought would happen across all property types. Really only lodging saw that uptick. We did see a modest uptick overall in loans that are in grace period. You might recall, those who have listened to us starting in March, that was the early tell that before we started seeing the wave of delinquencies, we saw a wave of loans using their grace period before going 30 days delinquent. We did see that go up about 10 basis points this month. So perhaps a small inkling that things are getting a little bit worse. And the worst of all in that category, two things. One was multifamily, interestingly, and the other was retail, which saw about a 1% jump month over month in the percentage of loans that are in grace period. So more to come when we put out our final numbers later this month, but those are some of the early indications.
Yeah, what's the multifamily grace period number? Do you have it in front of you?
It's almost 4%.
Holy moly. And that's
Right.
on top of 2.8, 2.9% in delinquency.
So it was under 2% for every month after June, with the exception of September. It cracked 2%. This month, it went from 1.3% to 3.8% on a preliminary basis, which I have to believe is probably a couple of those big.
That's what I was thinking. It's got to be a couple big ones.
Those big New York and San Francisco properties where they're using that grace period, maybe as a liquidity feature. Maybe they'll become current next month, or maybe it'll be one of these loans that's perpetually in grace period. Sometimes we see that. But that's certainly something to watch going into the new year.
Turning to bond spreads, what are we looking at there?
Yes, we promised one of our listeners that we would do this periodically, talk about where spreads are currently. On the conduit space, last cash flow AAA pricings in December, of which we saw 4 or 5. Last cash flow 10-year AAA spreads range from 71 over the swap curve to 85 basis points over the swap curve. That puts that pricing really on par with the tightest levels we saw, those levels that we attained in February 2020 before COVID really sunk in. So we have really made a tremendous round trip. And when you consider now that the 10-year Treasury is probably 100 basis points lower than it was in February, we're really talking about a lower cost of funds for borrowers in the office, multifamily, industrial segments, maybe even grocery anchored, than we saw 10 months ago. So just an amazing turnabout. On the BBB minus level, not quite as good, but still quite impressive. The spreads now between 400 over and 435 over. At the best points this year, we were probably more like 325 over. And we talk more about this in our year in review, but that's quite an improvement from where we were at the depths of April and May, where BBB minus spreads were 1,000 over, 1,200 over, something like that. So, really competitive levels right now, and a really good place to be for CMBS going into 2021.
So looking at some of these deals, I'm looking at the new issue spreads and trends page on Trepp, just a little shameless plug. And the last 3 deals, which are, around the levels that you're talking about, they still have like some retail and some lodging in them. I mean, one of them has 14% lodging, the other has 16%, another has only 4%. In the retail, it's 11%, 7%, and one of them was 32%. That must be there must be a story there, but it's not like it's 0%. I think the first couple deals coming out of the pandemic, which I'm looking back in August, September range, it was like 4% retail, 5% lodging, that type of thing. So they're coming back into the pools.
Yeah, my guess is that on the retail side, you're probably seeing the things being represented being Target, Walmart, Home Depot backed. I'd be surprised if you saw any shopping mall debt in there, probably some grocery anchored, even when we were just coming out of the short hiatus of May, June, and July when there was no issuance. Those early deals did have a little bit of retail, but it was that stuff that was outperforming because they were selling essentials. On the hotel stuff, I didn't dig into the hotel deals that got done, but we should make that an emphasis of our early January review to talk about what kind of hotel deals are getting into conduits, what kind of leverage they have, and what kind of reserving they have. That would be a great future podcast topic. One other data point for us on the spreads, we haven't seen any CRE, CLO pricings this month. So that has kind of dried up in December. That market kind of comes in fits and starts. The last levels we saw on kind of floating rate transition paper was from November. Spreads there on a floating rate basis, AAA LIBOR plus 170, junior AAA LIBOR plus 210, AA minus LIBOR plus 275, single A minus LIBOR plus 360, triple B L plus 475. That was kind of mid-ish November. The market has rallied since then. It wouldn't surprise me if a deal were to price now, we would see that, 10 or 15 basis points tighter across the board, as we saw in the conduit space in December.
You were talking about hotels, lodging, and the delinquency numbers being at about 20.21, and special servicing numbers also being significantly higher, 24.68%. We've seen, and we've talked about this before a couple times, on hotel owners looking to recycle their properties into other uses like apartments.
Yeah, so there was a interesting article in Wall Street Journal, as usually there is, about empty hotels get second life as tiny apartments during the pandemic. I liked, there was one line from Lee Stewart, a 32-year-old concert promoter who lives in a 300 square foot studio in downtown Austin. He goes, the whole millennial thing of spending 40 or 50% of your income on rent, it just doesn't make any sense. And I'm with you, Lee. I'm right there with you. As an old soul millennial, I don't want to be spending that much money on rent. So this particular company, Vivo, is working on hotel conversion projects kind of across the country. And basically, I mean, if you think about it, they're like upscale dorm rooms, right? And coming, younger people coming out of school, coming out of college are probably going to be more than happy to have that type of amenity, right? Especially if it's cheaper.
Is it going to be like the one bathroom at the end of the hall where people are walking past your room in a bathrobe and shower shoes?
Make sure you have your shower shoes.
A bucket of hair care products and other things. Is that what we're talking about here?
Let's hope not.
I hope not.
Let's hope not.
I want to know, but what I want to know, which was not in the article, is do I get the room service and the turn down service and the cleaning service? Now we're talking. If you're telling me you're going to come in and clean my apartment every day, that sounds pretty amazing.
I don't know if they had this in other places. Where I went to school, the big thing we had in our dorms freshman and sophomore year before I moved into private fraternity housing was this thing called the Super Suck, which was this vacuum that was in the hallway where you just attach this huge hose to a hole in the wall, and this enormous thing, which would be like the vacuum that would come out of a gas station device, would stretch from one end of the dorm to the other, and you'd vacuum your hallway that way using this one single hole that took a whole floor. And then every now and then something would happen to some poor guy who would drop his thesis, and it would be sucked into the Super Suck, and all his work for a semester would be gone.
You said
So
thesis with a TH, right?
I think we've actually referenced this exact thing on this podcast in the past. It's like when Rob Lowe gets his shirt sucked up by the male thing in Tommy Boy. Same thing. It's like not the dog ate my term paper. It's the what is it? The dorm sucker.
I used to have a bunch of cross-country guys in my dorm, and I always thought, those guys were 130 pounds soaking wet. And I thought if they walk by this thing, there's a good chance we never see them again.
I think they make minivans with the super suck now.
Yeah.
It might be in the cards for me before too long.
I thought he was talking about one of our football teams. So another story that's been making the rounds in a number of publications is a pair of billionaire brothers that are snapping up Manhattan properties. So they are looking for a variety of different property sectors, hotel, office, retail, and obviously the longer those properties don't have people visiting them in New York, I guess the better deal they get.
Well, I think people will get deals in this environment. I don't think that they're getting deals like people were getting in 1992 after the savings and loan crisis. I don't think they're getting deals like they were for CMBS bonds in early 2009. There's so much capital out there that I'm sure that their basis could be 20 or 30% less than they were looking at maybe 3 months ago, or probably more like 8 months ago. But I don't think people are getting anything for 10 cents on the dollar other than perhaps some shopping malls. I just think that there's way too much capital out there. We saw last week that that yoga location in Manhattan that was completely, the only tenant was a yoga spot at street level, going for $40 million. So I think we have a long way to go in a second round of COVID before things got even remotely close to where we were in other crises. And I do think with so much liquidity out there that the bottom fishers will either miss out or be disappointed that they're not getting better deals.
I mean, this is the long game, right? When you have this type of money to be able to invest, you're okay with buying in and saying, even if it takes a year or more for things to even get back close to normal, this is still Manhattan, right? And, Manhattan will be back.
Well, I was watching Squawk Box earlier today, and they had two guys being interviewed by Carl Quintanilla, right? One was Barry Sternlicht of Starwood, and the other was A-Rod, Alex Rodriguez, who recently was in the headlines for making some hotel purchases. And
who, by the way, we're trying to get as a guest on the podcast. So I'm pretty sure he listens. So A-Rod, let us know when you're ready.
Yes, we will share our tips with, CRE, if you'll give us your tips for getting a little bit more distance on our, our summer softball picnic,
home run derby.
Launch angle.
Yeah,
launch angle, right? I want something that'll give me, something better than warning track power. But they were talking about, to take the contrarian view of what you were just saying, Joe, Manhattan being back. I didn't see their whole interview. I caught it about halfway through, and they were really talking about the migration and how that will continue away from Silicon Valley, away from New York to, in their case, they were talking about South Florida and how that has so much more room to grow in the northern suburbs of Miami and so forth. And as you look more broadly in Florida into the Panhandle area and northern Florida. And it was an interesting interview. They were somewhat bearish on many of the major cities, although they did talk up very positively Boston because of its biotech presence. But they were two that thought, because of the leadership, because of the tax structure, because it's easier to find talent in other markets now than it was 10 years ago, that these southern low tax destinations will continue to attract big businesses.
Yeah, I tend to agree with that. But A-Rod and Barry both are based in Miami, so they're talking from their perspective. We're talking from ours,
So yes, A-Rod, reach out to us, help me with my launch angle. We'll talk multifamily, which I know you've done before, hotels, and and South Florida, and maybe share a mojito along the way.
Nice. I think it's a coquito in at Christmas time, though.
Yeah.
I think so. So we've talked about the pandemic's effects on numerous property sectors. One that we haven't talked very much about is senior housing, which may be experiencing a shift. Is it short-term or long-term?
Well, so I think one of the reasons we don't talk much about this is because it doesn't end up in CMBS very much, these types of properties. It's mostly in bank, insurance company, balance sheet type lender spaces. But there was some data out from a company called CareSet. And just this one graph here was the change in nursing home patients. These are Medicare facilities, so it's a certain subset of the market, but the change in number of patients from 2018 is down almost 40% over a 2-year period. So these kind of skilled nursing centers, I think that obviously there is a constant demand for this type of care and living arrangement. However, the delay, I think, is going to hurt the occupancies at these places for a while, right? I think if, all the people that were supposed to move into a place like this in 2020 didn't, and they probably won't for another year or 2 or 3. So, grandma might be happy, but I'm not sure if, mom and dad are that happy at this point.
Yeah, I think there'll be a long lag before this comes back, even if the vaccine shows efficacy very quickly among young people. I think that older people will want to see a longer track record of success of this. They'll want to make sure that wherever they're looking has a track record of, both cleanliness, procedures, and, low occurrences of COVID going forward. So I think that unlike something like an Orlando or a New Orleans, which may have a very quick snapback in leisure travel, if the vaccine turns out to be very effective and people start traveling very quickly, I think the senior housing becomes one of the last things to benefit from this. And in some ways, it could be the kind of thing where you say, my father, my grandfather, whatever, my grandmother is pretty self-sufficient. I was only putting them in senior housing just to make it a little bit easier for them so they had meals. Maybe they start going back more into traditional multifamily near a family, and the family takes it upon themselves to do things like deliver meals and have in-house visits, right, from a nursing home facility or something like that. So you're not surrounded by people coming and going all day in the staff and by other people visiting their relatives. So, you could see a real shift in how people handle this going forward.
So another chart here in this story backs that up is that from the Bureau of Labor Statistics, so the Fed essentially, or the federal government, nursing and residential care facilities employment numbers are down about almost 8% since January of 2020. And home health workers had a similar drop from January to around April or May, but they have recovered to almost 0% change. They're still slightly negative from beginning of the year, but that's probably big business for the next couple of years, is in that home health aid type work, especially if you can prove that you can do it without spreading COVID, right? If you can do it safely.
One of the things practitioners are attempting to get their arms around, and we've talked about this multiple times, is how to assess the impact to valuations as a result of COVID. And the impact is dependent on a number of factors that we've talked about before: property sector, geography, and things like that. Joe, give us some broad strokes of how we determine what that looks like and how we analyze that.
Sure. So when it's funny in the valuation space, it's like, why are you valuing the property? If it's an appraisal for a new loan, then oftentimes an appraiser feels stuck between a rock and a hard place. right? Because the underwriters and the bank already have an idea of what the property should be valued at in order to get the loan done. And so do the buyer and the seller because they've agreed on a price. So appraisers will look to comparable sales in the area. They'll look to historical performance of the property in terms of, revenues, expenses, net operating income, occupancy. And if they go real deep, if it's an office property or property with multiple long-term lease tenants, then maybe they'll do some serious, pro forma cash flow modeling. The problem now is, how do you do a valuation, which is supposed to essentially be a discounted value of all the future cash flows of the property, when the future cash flows of the property are not that certain, right? Before COVID, you could make some sort of assumption on when a lease is coming due or when a lease is expiring. What is the percentage chance that that lease will renew? Or, okay, this lease expires and I plan to probably have 85% of it renew or something like that. And you could put these assumptions in and kind of have decent backup for them based on historical trends and, market statistics and stuff like that. Long story short, now, like, how the heck do you come up with that number? Right. And I think right now what's happening is people are just putting in assumptions that say, well, we'll be back to relative normal next year and by next year. And we're kind of doing this kick the can down the road Band-Aid approach to say, I'm valuing the property with a COVID adjustment, but really, like, you're still using mostly normal assumptions. So something that we've done recently for a few clients is what we call a value loss index analysis. So we basically look at, how did values change during the last downturn? How did NOIs change? How did revenues change, expenses, occupancies, et cetera? And use that not necessarily as like indicators of what's exactly happening now, but to at least get a feel for what is the possible extent of damage, and then create a few different scenarios kind of upwards and downwards around that, to at least give valuators, I should say, appraisers or other valuation folks, at least give them a range of potential outcomes to choose from, as opposed to them sitting there with no data to work with. So, we don't know anything more about the future than anybody else, but we do have a treasure trove of historical performance, which, you can kind of pick and choose from to say, hey, in this particular market, the worst ever downturn in net operating income and occupancies across the spectrum on this particular property type was X. And if we apply that, here's what we get for our value. If we apply that times 1.25, here's what our value is. And it at least gives you some backup for coming up with some values in a very, very stressed time.
Yeah, I think the hardest thing to handicap at this point probably is office, right? I think that in some cases, right, things are very predictable. Industrial right now is incredibly well predictable. You can predict exactly what you're going to see for inventory growth and demand and so forth. The same is probably true, kind of on a binary basis, I suppose, for hotels. If you're assuming, right, COVID, the vaccine doesn't work, we see a second strain, lockdowns go on forever, we're all toast, right? So that's one part, right? It's one part of the equation. But if you're on the other side, which is we're going to see a recovery, that recovery may not be 100%, maybe it's 85%, 90%, something like that. You can compare it to past recessions and say, okay, how did we look like in terms of RevPAR and default levels and delinquencies and occupancy and so forth? And that's kind of where I'm coming out on the lodging side of things, that we come back, when we come out of this thing, it looks a lot like the tail end of a recession, that we don't get to 100% because business travel isn't great, but it goes back to what have been historically reliable metrics in terms of, this is functioning on 3 cylinders, not 6 cylinders, something like that. The big challenge right now is, and we already know, retail at the shopping mall level is largely toast too. The big question is office. And are we in the midst of an incredible behavioral change, right? Behavioral in terms of how much space we need, working from home, people not being in big cities. or do we return to where we were 3 years ago? And that, to me, is the hardest to handicap right now.
We've just released our taller bank CRE loan performance report. Where are the delinquencies in Q3 for banks?
For those that don't recall what taller is, it is a collection of data from us. We collect data from 17 major US banks. It's the same data that they submit to the Fed every quarter. They are giving us both C&I data and CRE data. We only talk about the CRE side here, but we do get both. The data is used by the banks themselves to benchmarks themselves in terms of what they're seeing in terms of delinquency levels by leverage, by LTV level, by debt service coverage ratio level, see what kind of loans on an anonymized basis their competitors are making overall. And it's also used for model building so that people can say, what can I expect for PD and LGD, probability of default and loss given default on commercial properties from bank loans. So that's what we use it for. We update it quarterly. It usually comes in about 45 days after the end of the quarter. So recently we finished up our Q3, so our 9/30 numbers. The end of Q2 saw the market being incredibly stable. While we did see an uptick in delinquencies were still under 1% overall across all property types compared to what was 9% at the time for CMBS. What we've seen now in Q3 is remarkable stability continues. It's still under 1% overall, with one exception, and that is with hotels. That for the first time, we've seen a meaningful spike in that category. As of 3/31, the delinquency rate for banks was just 1%. It was still only 1.3% as of 6/30. Part of that could have been banks giving their borrowers some forbearances, some relief, right, some other accommodation. But at the end of Q3, that was up to 3.2%. So the first meaningful uptick, and the only real source of concern, even retail among banks, is still under 1.5% at this point. In terms of what the banks do, we've brought this up before. When it comes to retail, the banks don't have a lot of shopping mall debt. They don't do things of that size. They're more likely to be doing the community shopping center or the grocery anchored, which probably contributes to the fact that their delinquencies are so low in that category. On the hotel side, very unlikely they're doing that $400 million Boca Raton luxury hotel. Chances are they're doing roadside hotels, business travel hotels in their neighborhood. But even that, as we said, for Q3, 3.2%. So close to a tripling from what we saw 6 months ago.
So something which I find interesting here is the risk ratings migrations. So that's something, the banks all have an internal risk rating assigned to each loan. And we basically standardize those so that they're all on the same scale, a 1 to 9 scale, 1 being essentially no risk and 9 being essentially default. And if you look at the change from Q4 2019 to Q3 2020, if you look at the bar graphs, essentially the 2, 3, and 4 buckets, which are usually the, standard doing okay type buckets, have all had, I would say, significant, maybe slightly less than significant, but at least visible decreases. And the 5, 6, and 7 buckets have all had pretty decent increases. So, the loans are transitioning from the lower risk buckets to the higher risk buckets. And if you look at obviously, it's like, again, a dead horse, but retail and especially hotel have had the biggest increases in those 5, 6, and 7 buckets.
Yeah, this might be more meaningful than the delinquency numbers themselves. And they really tell an interesting story. Overall, the percentage of loans that were in 1 to 3, so really that would be your Class A loan, really expected to perform through thick and thin. The percentage of loans in one of those 3 categories was 42% as of Q2. In Q3, that dropped 11% to 31%. The loans that were in 6 to 9, so these would be the things that, if you're at a 9, you're kind of almost dead loan walking. If you're 6, you're a real area of concern for a bank. Those jumped from 6% of the pool in Q2 to 22% in Q3. So that would be akin to saying, 22% of the bank loans at this point are kind of on watch list right now. That's what you would put on watch list, or with a special servicer if you want to come up with some kind of comparable. The hotel stuff, really kind of unbelievable. The balance of hotels rated 1 to 3, so kind of that AAA rated Gold Star hotel, that went from 36% in Q2 to 3.6% in Q3. So almost no hotel loans on banks' books at this point are considered, gold standard level at this point. On the other side, the percentage of loans that went into the 6 to 9 bucket, so the ones that are of most concern, 5.1% in Q2, 74% in Q3. So this impacts how much you're reserving against loans, what you expect your loss to be, what the size of your loss is to be. And what this is telling you is, even though the delinquency level is not yet showing it on the bank loan stuff, the risk ratings are telling you that the hotel debt market for the banks is quite a mess.
So moving on to deals of the week, Manus.
Yeah, I got a whole host of deals for the week.
Deal week, Christmas edition.
So I don't always have the principals involved in terms of the individuals who brokered these things, but there were some real nice green shoots among the stuff that I chose to pull out. Number one, Driftwood Capital has acquired the Hilton South Lake Town Square. It's in the Dallas suburb of South Lake, not too far from the DFW airport, Dallas Fort Worth airport. Price undisclosed, which is often the case these days in hotel sales, because people don't want to give away the secret sauce of what they're getting these hotels for. But just the fact that something sold in an airport region is a terrific sign. It's a 248 room, 5-story hotel. And that came to us via the Hospitality Net website. Another Hospitality Net story, the investment firm Lowe acquired the 215 room Miramonte, or is it Miramont, resort and spa in Indian Wells, California. It's a luxury boutique resort in that town. Again, price not disclosed, but we love to see hotels get sold. It shows that the market is opening again. This was my favorite of the 3 hotel sales that we saw. This came from the Real Estate Daily Beat. Ivy Realty bought the 175 room hotel at 338 39th Street in the Garment District of Manhattan for $31.5 million. This was really noteworthy for 2 reasons. One, that particular block is loaded with hotels, so tons of competition. This hotel, I believe, wasn't even open yet. They still got that $31.5 million bid. And Manhattan, as we know, has seen a glut of hotel rooms. So for this thing to get sold on a street that has a lot of hotels in a market that has an overabundance of capacity is another terrific sign. Lastly, this one comes to us from Shopping Center Business. The property Shenandoah Plaza in Noonan, Georgia, sold for $10.2 million.
Noonan.
It is
Noonan.
a 150,000 square foot property anchored by
Podcast at Trepp.com for anyone who understands that reference.
Sale price $10.2 million, anchored by Big Lots. Also has a Dollar General, but it has some kind of low end things that you would think might have been hit hard by the pandemic. A Rent-A-Center, for example, is one of their tenants. It also has a Goodwill. The seller was Georgia Capital. The buyer was Hackney Real Estate Partners. SRS repped the seller, Georgia Capital, and the individuals there were Kyle Stonis and Pierce Mason. I hope I pronounced those names correctly. I know I just butcher one or two every single week, and goodness knows it's not intentional. I do my best.
At least you're consistent.
Yes.
So we have a number of shout outs. Brad C. from Atlanta, John F. from Indianapolis gives us 5 stars. Thank you, John, for that. Jerry W. from Houston looks forward to the podcast every week. Carlos M. from Florida, he encouraged Joe to splurge on that fire pit that he was thinking about last.
So let me tell you
pod.
a funny story. This email from Carlos came in saying, get the solo stove. It's worth it. Literally a minute later, I get a text from my wife with a picture of the Solo Stove website. They're selling it for like $150 less than they normally sell it for. So I said, that's got to be a sign. So I'll let you know my review when we get it. It's going to be like 3 months until I get it, but that's
Thank
okay.
goodness. I thought your wife was going to show you a picture of Carlos. I thought that's where you were going with that.
Oh
And
my.
man, I was ready to catch my breath.
It was a sign. The planets lined up and everything. So apparently Carlos only uses his fire pit 3 times a year. He does live in Florida, but
He is in Florida.
He did give it a recommendation. Kurt A. from San Francisco, he said he loves to geek out on CRE data with the podcast. He also made a comment that the office apocalypse is coming, which I believe he gave credit to Propmoto for that term. He says office is the next sector after retail to take a hit. And he asks the question, is there enough stimulus to throw at the structural changes coming to commercial real estate brought about by and accelerated by the pandemic in a post-COVID world? We'll probably talk about that all next year.
Yes, we did have one more gentleman reach out to us who wanted us to do more work, more explanation on warehousing, how that works, and kind of do more educational segments on that.
That's warehouse financing.
Warehouse financing.
Yeah.
We it's not our sweet spot. We'll admit it, but for that gentleman, if he's listening, we're going to reach out to you early next year and get your thoughts on the matter. So thank you for your patience.
A couple more. Mark T. in California, he had a forecast. His forecast is, I think, Manus, in line with what you were saying at the top of the podcast. He sees light at the end of the tunnel somewhere in May or June of 21, but much worry and economic hardship until then, regardless of stimulus, due to the time delay of getting the stimulus out to people who need it. Any stimulus given to people and businesses in 21, he thinks, will shore up past financial issues and will be limited in stimulating the economy. So
yeah, I think we agree with that. And it kind of goes with, Kurt asked that question that you brought on, which is, can the stimulus do anything for CRE? And maybe a stimulus can, and maybe there's more creativity out there somewhere. Other than using the FF&E reserves and the idea of issuing private equity, there really hasn't been anything on the creative side that will help movie theaters, casual dining, Chuck E. Cheese, other things like that in the short term, high-end restaurants. So I think that, there's more creativity needed on that front for us to solve some of these problems.
And Tyler A. had a question about hotels that had prepaid without penalty and was asking about which ones we were referring to. We will send an answer to that if we haven't already. So thank you for the shout outs. We had a number of outreach in the last several weeks, so we tried to get to every one of them.
We, on that prepayment side, the question came in last week and we didn't answer it immediately because we hadn't written about it in Trepp Wire. We try not to give away too many of the jewels on the podcast before we've written it for Trepp Wire and our paying customers. So in that case, I believe we wrote about it and that story went out either this morning and will go out tomorrow morning. So now we're free to share that story with any of our listeners. And if you would like to see it, ping Martha or Joe or I, and we'll make sure that you get that data.
And the Federal Reserve released its mid-year stress test results for large banks. The tests indicated that large banks would be able to maintain strong capital ratios even through a prolonged downturn. What were some of the key takeaways?
Yeah, so the answer is that things were worse. Loan losses or expected loan losses increased from, I think it was 432.5 billion total, and this is across all the banks that the Fed covers, up to 514.3 billion. So essentially what happened is the Fed came out with a new, worse scenario. I think they came out with actually 2 COVID specific scenarios that were worse than the severely adverse case. And historically, when I've been dealing with banks for the last 100 years, the mid and small size banks, when they see their results in the severely adverse case, they often fall off their chair and say, that's insane. This bank has never seen losses like that, 3, 4, 5% loan losses. And usually the answer is, well, we've also very rarely seen a macroeconomic scenario of this magnitude to the downside. And then all of a sudden we did in reality. But a couple of interesting points there was that CRE happened to be one of the biggest contributors to the increase in losses. So I don't know, are we putting out a review of these coming up soon or no? Yeah, so that should be coming out shortly. So check that out when we publish it.
It's been released today, I believe.
There you go. Right on time.
This time of year is usually met with traditions that include family gatherings, travel, or attending festive parties. This year, of course, we need to change that completely. We do have the opportunity, however, to create some new traditions to keep us upbeat and sane. So what do you have in the works, Joe?
Feeding a newborn baby and waking up 3 times a night, and it's not really Christmas. I mean, I think we're going to order sushi on Christmas Eve and stay in.
Nice.
And that's going to be nice in a lot of ways, but also a little bit sad in some other ways. So I definitely will be watching It's a Wonderful Life no matter what. That is a no doubt Christmas Eve tradition. I used to watch Christmas Story, but I'm out on that movie now.
Manus.
I was hoping that this is not a tradition per se. This is, we're taping this one day after we were supposed to see what was kind of deemed the superstar, which was going to be an alignment of Jupiter and Saturn that was going to appear to be this incredibly bright light in the sky. And I just had this feeling that it was going to bring in a whole new start to things. It was going to mark the end of 2020, the beginning of 2021. It was going to be a sign from the gods that we had turned the corner. But alas, in New York, we had cloud cover and we couldn't see it. But they
locked it down, actually.
They locked it down. But it was something that we hadn't seen. Nobody had seen it. It hadn't been around, this particular alignment, in 800 years. And I think it doesn't come back again for another 400 years. And I was really, really counting on this bringing in, harmony and understanding, sympathy and trust abounding, no more
Age
falsehoods
of Aquarius
and derisions, golden living, dreams of visions, mystic crystal revelation, and mind's true liberation. And yet,
the age of Aquarius.
We got cloud cover.
Well, to be the optimist, it does come every 20 years. So not to the degree that it was last night, but.
And for those that were not sure what I was saying, technically, it's when Jupiter aligns with Mars and the moon is in the 7th house.
Saturn.
So yesterday was Jupiter and Saturn, but I'm still hoping for harmony and understanding, sympathy and trust abounding.
Manus needs a hug, I think. So with that, we'll close. Thanks to our producer, Keegan Senanjme. Join us next week for our year in review, where we offer up a report card, if I could say it easier, a report card of sorts for the year. If you have a question or a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Happy holidays. Thank you for listening and stay well.